The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we take a look at the market trade for Thursday, we had a mixed day overall, I would say. Soybeans, bean oil did trade a bit higher with moderate pressure in corn and wheat. Cattle futures had a good day as well. By and large, we got that U.S.-UK trade deal announcement. We're getting more details rolling out, but it seemed like the ag markets didn't show much reaction at all to that news. We're going to talk about that, weather, and much more. Joining us now, Brian Doherty, Senior Market Advisor with Total Farm Marketing. Brian, good to chat with you again this week. And I know for a lot of traders, the headline of the day was this U.S.-UK trade deal announcement. Yet, as I mentioned, the details are still pretty fuzzy. Sounds beneficial for U.S. agriculture, particularly ethanol and beef, but yet markets, ag markets anyway, just kind of didn't seem to want to trade the news at all Thursday.
No, they just had a tough day. It looks like they took a sort of another risk-off day in the grains. In particular, corn down 5-6 cents most of the session. Did come back near the close. Really good export sales, though. So you got to acknowledge that 65.4 million old crop corn. Gosh, brings the total to just under 2.4 billion. I think I did the math this morning, about 27% ahead of a year ago at this time. Good numbers there. Beans solid, 13.8 million there too, about 200 million bushels ahead of a year ago at this time. But I think the market is trading what I'm going to call fact. And the fact is that planting progress will be ahead of schedule by the end of this week. I think that's a fact. Does that make sense? I think it's a fact. You've got a really good weather forecast, and it seems like since the weather forecast really took a turn for the better, grain, particular corn, has been nothing but on the defensive here lately. So you've got the fact of good exports, and I think that the managed money looks at that and says, well, as we look at the big picture, all we need to really know is planting progress on pace or below or what, and it's on pace or better. So it looks like there was some serious long liquidation, short establishment of positions, or both. And yet, good export sales announcements this morning couldn't hold the market up. Good export sales on the weekly Thursday USDA export report couldn't hold the market up. So quickly into the oversold territory, but a pretty rough day in the corn and wheat again.
Well, when you look at this corn market too, I know we've been seeing a bit of a breakdown in that July Dees spread as we're kind of in that time period where we're rolling a lot of the emphasis away from old crop and into the new crop. And yet, here's this corn market that's just kind of, how do I put it? Maybe folding in on itself a little bit here. It's been a tough week. I feel like in this corn market, Brian.
Well, it has, and farmers are really frustrated with it because corn, it's not like corn started at $5.50, and now it's really feeling the brunt of good progress for field or expectations for good progress. 465, 470 doesn't really cut the mustard very well. And then all of a sudden you're in new crop, you're under 450, and then you're under 440, right? So some pretty challenging times early in the year. Now, not unusual, just it's the speed at which it decides to fall the last couple of weeks. Despite in general a big drop in the dollar from where it was in January, pauses on tariffs, all of these things. So for me, it just boils right back down to what is the market, and the market is the collective vote. What is the collective vote trading? And it's got to be trading just the idea of increased planting progress into next week, and maybe a real quick wrap up to the planting progress. Now, all that being said, the drought monitor map is still colorful, and part of the reason planting progress is going quickly is because the western half of the Midwest stays, I'm going to see in the abnormally dry D1, D2 drought. That's not where you want to necessarily be in early May without much in the forecast.
No, that's very, very true. Curious with the wheat market too, as you mentioned, we had pressure there, and I know we had a Stats Canada number that came out Thursday. Canadian stocks look like they are larger than expected, and you combine that with U.S. and other world wheat stocks here, and you look at that whole picture, plus going into a WASDE report early next week. I don't know what to make of this wheat market trade either this week, Brian.
Well, it just keeps slipping into new lows, and it's it's a trend, and when the trend is down like that, there's a number of things that happen. One, it's maybe down for a reason. That is, you keep getting these little bits of positive news. The Russian crop's a little bit bigger now, and Russian exports are going to be a little bit bigger. The Canadian crop's a little bit bigger. The Oklahoma crop, second year in a row, over 100 million bushels. That was viewed as negative earlier in the week. So there's just a lot of, and then Stats Canada. So you get a lot of things that kind of just, I'm going to say it's like 1,000 cuts. It's kind of bleeding the market right now. That being said, again, really good long-term value to end users. And as much as the dollar had been down, we're just really disappointed that there wasn't an inverse relationship with wheat prices and the dollar here in the last several months. And so it's a bit discouraging. All that being said, we're not throwing in the towel on wheat or corn or beans. It's just that timing of it is that it got weaker, I think, a little sooner than we expected. Again, I'm going to circle back to these crops still need good weather to mature in wheat and harvest. Talking to some farmers, let's say in that Oklahoma, call it Northeast Texas region today, things look pretty good, but they're pretty wet too, and don't need too much more rain. Then the quality starts going down. So there's always a dynamic somewhere that may come into play. Suffice it to say, the world just isn't charging and knocking down the U.S. door on the export front, though.
Well, thinking about these grain markets from a risk management standpoint here, just as we watch things kind of grind away here, grind along, however you want to put it, during this planting season, you throw in a trade deal that doesn't really move the markets all that much. And I guess from a risk management standpoint, farmers' perspective here, I mean, is there anything key they need to be thinking about here and at this point in time right now, Brian?
Well, there's always something you should be watching for. Now, on a pullback like this that we've seen, if you're not necessarily interested in selling cash, keep a really tight eye on the basis levels because typically we'll see those begin to improve, and maybe there's basis contracts that are lurking out there that might be really advantageous when farmer selling becomes somewhat thin. And so you've got that to look at. As far as big picture perspective, we start the year out back in January, talked about what does it look like for corn, and we said, well, if you have an acreage increase and yield the same as the previous year or somewhere close to 180 a bushel, you're probably still looking at $4 or less December corn futures. The market closing today, 438 three quarters. Is that enough to protect this time of year? You'll have to make that call, but still, there's strategy out there. You could buy a put, sell a call. You could buy a put, sell a put. There's different varieties of strategy to try and defend downside. Um, Probably the big, two big items that I think in the corn that are again sort of paramount is just the planting progress and well, here's a rhetorical question. What have you heard out of South America or Brazil lately? If you
Mhm.
said not much, well, that means things are going pretty good. And private estimates are starting to push that corn crop a little bit higher as well in projections. So bigger South American crop, good planting progress, technical weakness, all in the oversold territory on all the futures contracts, but still worthy of looking at. Keep what's the right word, keep turning those rocks over and looking for opportunities. You just got to stay at it. That's what we do. We stay at it. So if you have any questions on any of this, make sure that you ask the right people or ask people who are working toward this.
We're having a conversation with Brian Doherty, Senior Market Advisor at Total Farm Marketing, here today on the show. Let's go over to that livestock complex, cattle futures, more strength there on Thursday, Brian, especially feeders. I know that August contract got above that $3 mark here, closing 301.25, setting more records. I mean, it just at this point it just doesn't, how do you make sense of what this cattle trade continues to do day in and day out, Brian?
Yeah, and some of the darker, call it clouds on the horizon. Well, the export market's beginning to show signs that it is slowing, right? So there may be some trade deals in the works, and it seems like the protein complex, whether it's milk or cattle, hogs some to some degree, not as much, but it seemed like that once the pause and tariffs went into play, good value to be had in some markets. but we sound like broken records. It's the supply side for cattle, and then just good demand where that's the big surprise that the consumer continues to step in front of this and be willing to buy. And even on the futures market, if you are a trader, June cattle all of a sudden run up to 214. Yes, cash is higher, but at what point do you measure the risk of going long because cash is higher only to find out cash flips, the board flips, and you're down limit, right? So to me, there's a mounting amount of anxiety over increased risk by going long the market despite elevated cash prices. But yeah, I've been surprised as many that the cash market's held up this long as well as it has.
Well, and one has to wonder your point about exports, but what about consumer demand? We've talked about this so many times. When do folks, get tired of certain prices for higher cuts of beef? We've heard a lot about the trade down to ground beef, for instance, from say steak and some of those nicer cuts for a lot of folks. But, at what point do consumers start to push back, so to speak, at the retail counter? I think if you couple that maybe with exports slowing, that could be some of what potentially slows down this trade action.
Yeah, and it's a great question. So when do consumers push back? And I'm going to anecdotally share two quick personal stories. My youngest daughter just came home from college, and we said, well, let's kind of celebrate her successes and take her out to a dinner, just a family type restaurant, nothing fancy at all, kind of a restaurant that serves you quickly, gets you in and gets you out. And we sat down at the table there, and there were five of us. And my wife looked at the menu and saw that the steak was $24, just a steak menu. It's 8 ounce steak. I think it was 8 ounce, might even been seven. And her first words were, "Well, we're not buying steak." So that that was the end of that.
Yeah.
But my point, that's when you look at that, it's a lot of money for, let's say, consumers who are tight on a budget, even though you might want to do a little celebrating. Uh, you can get a rotisserie cooked chicken in some of the box stores, $7 or $5, right? And that goes a long way. So it does make me wonder how much the demand market can continue to move into this beef market, in particular if the grilling season kind of gets behind us here, or at least the buying for the grilling season gets behind us. It's just an amazing demand as well as supply driven market, but more demand driven, I think, than supply. It's just it makes one scratch your head. Now that being said, the one thing I will say, Jesse, that I want to when I talk to a farmer or production, someone in the production pipeline, what I want to be prepared for is the market can look strong for months on end, but when it flips, it can get violent, and you could see a 10% drop in beef, practically in a week. That's a $20 move on the board. 15% drop, all within reason. Historically, 15% drop would be a $30 drop. So you need to make sure that you're using the right tools. Either you're comfortable forward contracting or hedging, but then you need to meet margins, or you purchase the puts or buy some out of the money puts as a safety valve.
How about over in that dairy market trade? What are you watching there this week, Brian?
Big volatility, big strength in the milk market. Nice jump in cheese prices. However, the USDA, in their daily cheese commentary, they're kind of talking about cheese supply starting almost back up again. So you had a big short cover rally, a big, nice inverted head and shoulders formation. Excuse me, on charts, and technically went right into the zone where you'd want it to go to. Um, we're seeing butter at the U.S. level priced competitively in the world market, but it really hasn't picked up much ground yet. So there is maybe room for butter to pick up, but it looks like the cheese recovery could be maturing. We still got the spring flush in play, and there was a renewed sense of confidence once it looks like tariffs were pushed back. And U.S. cheese, as we made the argument that on the world market should be a really good value, and we saw that in global dairy trade this week. So upticks in the demand, but I don't think we're at at a pivot point here where the market is rallied up sharply and now going to make another leg sharply higher. I think we're going to run out of gas here. I know producers don't want to hear that, but the last production report, it didn't give us any sign that we're going to run short on inventory anytime soon.
All right, Brian, final thoughts here today. What would you leave folks with this week?
Yeah, so as far as like the grain markets are concerned, in particular corn, beans, and wheat, I'd still approach things with a defensive posture, but we might be quickly approaching a price point where it is okay maybe to do nothing right now and take some risk. For a lot of farmers, depending on what they bought up on insurance, but you got a 470 December corn price average on insurance. Is there a necessity to defend prices on May 8th at these current levels? Maybe not. So I guess I'd leave you with, if you're thinking about doing nothing, you're probably not alone. They always say doing nothing is still a strategy. But the more we kind of compress the spring now, especially with a colorful Western Corn Belt drought monitor map, quicker prices could quickly, uncoil and at least bounce back up to respectable starting points, which is probably 475 on December.
All right, Brian, if folks want to reach out to you at Total Farm Marketing for a conversation, what's the best way?
I think the best way is through a phone call, which would be 800-334-9779, or contact me through email, Brian with a Y, at totalfarmmarketing.com. Love to field questions and educate and help people out.
Brian Doherty, Senior Market Advisor, Total Farm Marketing. Good to chat with you again. Have an awesome weekend. We'll talk to you next week.
Jesse, thank you very much. You as well.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.